Have you ever wondered what really makes the rich get richer and the rest of us struggle to keep up? Today, we're diving deep into a concept that could change the way you look at buying a home forever. We're talking about the distinction between assets and liabilities, specifically in the context of homeownership. Knowing this could not only save you from potential financial pitfalls, but also set you on a path to greater wealth. Stick around till the end to get full insight, and don't forget to hit like if you find the information helpful. We start with the basics. What is an asset and what is a liability? An asset, simply put, is something that puts money in your pocket. In contrast, a liability is something that takes money out of your pocket. It sounds straightforward, right? But when it comes to homeownership, the lines can get a bit blurred. Typically, a home is considered an asset. But could your home also be a liability? Let's explore. First, let's consider a home as an asset. A home can increase in value over time, which means it can be sold for more than it was bought for. It may also earn you rental income if you decide to rent it out. These factors make it seem like a clear asset. But there's another side to this. When does a home become a liability? Think about the ongoing costs: maintenance, taxes, mortgage payments. If these costs are higher than the income or value increase, your asset might actually be a liability. This is particularly important for potential homeowners to consider before buying. Now let's break down the smart way to approach homeownership. Firstly, do a realistic assessment of all the costs involved versus the potential income or value increase. Secondly, consider the location carefully. An ideal location can boost your property's value significantly. Thirdly, look for potential tax benefits or government schemes that can make homeownership more advantageous. Here's a practical example. Imagine buying a house in an upcoming area that is expected to develop over the next few years. The infrastructure around the area is improving, which means the property value is likely to increase. Plus, you plan to rent out a portion of the property, which covers the mortgage payments. In this case, the house is a clear asset. But take another scenario where the home is in a poorly connected area with high maintenance costs. The chances of property value appreciation are low, and so are the rental prospects. In this scenario, what seemed like a great asset turns into a liability, eating more money than it provides. Throughout these examples, you can see why understanding the asset versus liability dynamic is crucial for financial success in homeownership. Have you thought about these aspects when buying a home? Share your experiences or thoughts down below in the comments. I would love to hear what you think. And if you found this video helpful, please like and share it with friends or family who might benefit from these insights. To sum up, homeownership can indeed be a path to wealth if approached correctly by differentiating between assets and liabilities. Always remember, the goal is to make informed financial decisions that lead to positive cash flow and not just follow the crowd. Thanks for watching. Make sure to subscribe for more practical financial insights. See you in the next video where we'll explore more ways to manage your finances wisely.